Right now, there are two very loud groups screaming at you online. Group 1 says memory stocks just got cheaper, so back up the truck. Group 2 says the party's over, the AI trade is a bubble, and you should be selling everything with a pulse. Here's the thing, they're both wrong. And normally, when two sides argue this hard, at least one of them stumbles into being right by accident. Not this time. What's actually going on is way more interesting than either take. And if you don't understand it, you're going to lose money whichever side you pick blindly. So let's slow down and actually look at the data. Micron was trading above $1,250 not that long ago. Today it's sitting closer to $850. That's roughly a third of its value gone in under a month. Now normally a drop like that screams something broke. But look closer and the fundamentals are actually some of the best in the entire market. Huge earnings growth, strong sales growth, a valuation that's still cheap relative to that growth. So here's the weird part. The stock's technical strength score is elite, but the money flow indicator, the one that tracks whether big institutions are buying or selling, is flashing sell, not buy. Sell. Think about that combo. It's like a kid bringing home straight A's and the teacher's note at the bottom says, doesn't play well with others. The grades are great. Something else is off. And that something else is the real story. Here's your first clue that this isn't a Micron problem. Every stock tied to memory chips got hit at the same time. The storage companies, the drive makers, the Korean chip makers, the semiconductor ETFs. Same week, same direction, same intensity. When an entire sector falls together like that, it's rarely about any one company's earnings call. It's about positioning. Too many people were leaning the same way, and they all leaned back at once. And the numbers on how crowded this trade got are honestly kind of wild. Surveys of the world's biggest fund managers found that betting on semiconductors had become, by a landslide, the single most crowded trade on the planet, way ahead of anything else. On top of that, there's this whole hidden layer of leveraged ETFs, funds that basically amplify the daily move of these stocks. At the peak, the trading activity tied to those leveraged products was creating billions of dollars in mechanical buying and selling every single day. That's not humans making calm decisions. That's algorithms reacting to algorithms, a feedback loop of machines panicking in sync. So when the leverage unwinds, you get exactly what we just saw. A fast, ugly, sector-wide drop that has way more to do with positioning than with the actual businesses. Now let's separate the price action from the real world, because those are two different conversations. The demand story behind AI memory chips is still enormous. We're talking about a market that's projected to grow more than 20-fold by the end of the decade. Big tech spending on data centers keeps climbing year after year with no sign of a ceiling yet. Even the equipment makers, the companies that build the machines used to manufacture these chips, keep raising their outlooks. One of the biggest just hiked guidance for the second time this year and is expanding factory capacity aggressively, already booked out years in advance. You don't do that if demand is drying up. Nobody builds a bigger restaurant because business is slowing down. And Micron specifically has locked in tens of billions in contracts where customers already paid cash upfront for chips that haven't even been built yet. They're sold out on their highest-end memory product for years. So no, this isn't a broken company. This is a hot business going through a rough couple of weeks in the stock market. Now here's where I have to be honest with you because that's the whole point of this channel. There's a real growing concern that memory chips are getting so expensive that they're starting to eat into the profits of the very companies buying them. Some analysts think memory costs could balloon to well over half of total spending for cloud providers within a couple of years. And we've already seen an early warning sign. Samsung, a company that literally manufactures memory chips, just posted its first ever quarterly loss in its phone division. Why? Because even Samsung couldn't stomach putting expensive memory into its own phones profitably. That's like owning a bakery and not being able to afford your own bread. There's also a bigger debate brewing about whether all this AI infrastructure spending is actually going to pay off. The chip makers have captured most of the gains so far. The big tech companies footing the bill are starting to feel the pressure, and some of their stocks have underperformed because of it. If that return on investment doesn't show up eventually, the spending itself becomes hard to justify. And on pricing, some analysts expect the growth in memory chip prices to start cooling off later this year, not crashing, just slowing down. But in a market that had priced in non-stop acceleration, even a slowdown can feel like a gut punch. So is the party over? No, the data doesn't support that. This is still one of the biggest growth stories in tech right now. But, and this is the part the buy everything now crowd doesn't want to hear, nothing rockets up several 100% in a year and then just keeps climbing in a straight line. That's not how markets work. Every parabolic move needs to cool off and reset before it can build a real foundation for the next leg up. Right now, what we're likely seeing is a healthy distribution phase. Big money taking profits, leverage unwinding, positioning resetting. That's normal. That's actually a good sign long term. But phases like this can drag on for weeks or even months, and sometimes they turn into a deeper slide before a real bottom forms. You don't need to catch the exact bottom. You need to wait for the stock to actually build a base first. I know that's not the exciting answer. Everyone wants to hear, buy now, this is the moment. But if someone's telling you to buy the dip with total confidence right now, ask them one simple question. Where's their exit plan if they're wrong? Because conviction without a plan isn't a strategy, it's just a hope. The long-term data gives you the roadmap for where this sector is probably headed over the next few years. But the price action right now is telling you to be patient. So that's where I land, not panicking, not selling, but also not chasing this dip yet either. If this kind of breakdown is useful to you, subscribe and turn on notifications, because in a market moving this fast, you don't want to miss the next update. And remember, this is for education, not financial advice. Always do your own research and manage your risk.